Hello and welcome to another market update. Been a pretty wild week. Hope everyone is staying alive out there. These markets are certainly kill or be killed. But let's just get straight into it with the summary of the stories I'll be touching on today. So first up, we have U.S. inflation, which came in at 7.7% for headline and 6.3% for core.
My man!
May not sound positive on its face, but both those numbers were surprises to the downside, so good news from the market's perspective. And then we had Fed officials saying that they still see tighter monetary policy ahead.
What?
So we shouldn't get ahead of our skis. But we also had consumer price inflation, or PPI, come in at 0.2% month over month, 8% year over year, and 6.7% year over year for core, which were all positive numbers. Again, the high numbers can be a little misleading, but it's about the rate of change and the direction. But we'll get into it. Next up, we have Japan's inflation, which is expected to hit a 40-year high.
Damn!
Only like 3.5%, which is nothing compared to Western numbers, but a 40-year high nonetheless. Then we have EU oil sanctions are driving Russian oil to Asia.
Say what?
And finally, as you can expect, crypto contagion continues, and BLOCKFI is its latest victim, saying it has significant exposure to FTX and is at risk of bankruptcy. All right, but before we get into those wonderful stories, let's go over last week. So we had the Federal Reserve raise interest rates by 75 basis points, maintaining that hawkish stance. The U.S. added more jobs, but unemployment edged to 3.7%. I suppose if you're the Fed, though, that is positive because you want unemployment to increase. Kind of crazy. Then we had Meta say it's cutting 11,000 jobs, or 13% of its workforce.
Oh, hell no!
They weren't alone in terms of tech companies firing, but obviously that is a big one. Then we had the UK set, and I guess still set, to announce a huge natural gas deal with the U.S.
Whoa.
So stay tuned for that. Then we had regulators setting tougher climate change, or actually thinking about planning to, I guess, set tougher climate impact rules after the annual climate change conference, otherwise known as COP27. And again, as you can expect, the crypto and FTX token plummeted as the market continues to battle the FTX Alameda contagion, but obviously we will get into that. So let's just start off with our first story. All right, so we got in the inflation for the U.S. So as I mentioned, it came in at 7.7% in October, the lowest since January, and below forecasts of 8%. So that was the key thing, because 7.7% is still high. And, you know, I remember seeing these memes of this guy, or when we looked at 7.7% on the upswing, the market just lost it, terrified. But now that we're on kind of the downswing, 7.7% is, fucking awesome, apparently.
My man!
It's just kind of funny. But anyway, a 0.3% surprise to the downside is good news. Shows inflation is looking like it's going to slow. And I guess I'll get to it. This is for headline right here, but core finally slowed because previously headline was decreasing. You can see right here if you're looking at this chart. We peaked at 9.1%, and the trend from then has just been clearly down. 8.5 the following month, 8.3 the month after that, 8.2, and now 7.7. So we're headed in the right direction. People saying that we're beating inflation. But now that core inflation, if you look at this one right here, core inflation is now headed down because the previous month was actually the high. So even though headline CPI peaked in, May, 9.1%, we had core inflation peaking just not last month, I guess October is technically the last month, but in September at 6.6%. So now that we had this retracement down to 6.3%, people are kind of saying we conquered inflation and, the Fed can ease up a little bit. We'll see, obviously. But let me just go over some of the specifics. So we had a slowdown seen in food, 10.9% year over year versus 11.2% the previous month. And used cars were a huge, drag in the right direction on inflation, 2% versus 7.2% the previous month. So huge move. And then shelter 6.9% versus 6.6%, so actually went up. And then fuel oil was a big driver, especially like in the energy part of it, because you see the energy thing going up like crazy. It was largely because of fuel oil. I guess year over year, it says right here, 68.5% versus 58.1%. I think month over month, it was over 19%, which is crazy.
Not crazy.
But overall, obviously, this is a good sign that inflation is going down, but figures continue to point to strong inflationary pressures and broad price increases across the economy, mainly in the services sector, while prices of goods have benefited from some improvements in supply chains. And then actually I have a little walkthrough right here of the month-over-month items. So keep that in mind, month-over-month, not year-over-year. So you can see blue is this most recent month, October, and red is going to be September. So we'll just start from the top. So as you can see, shelter and food, they have been declining. We're seeing some disinflation there. Actually, I can add the previous month too. So you can see, again, looking at the top, food and beverage, shelter, they've all been on a steady consecutive decline month over month. Same with apparel, and apparel, we've actually seen disinflation, for the previous items or baskets I just mentioned. It was just disinflation, just basically getting closer and closer to zero, whereas in apparel, we've seen outright deflation. The only things that are really notable, or are the most notable things, I guess I should say, are energy has been kind of all over the place. Just a lot of craziness in that market, because we went from like 2 months ago, -5%, so like deflation. Then the next month, -2%, and now we're positive 1.8%, so kind of all over the place. But then if you look at used cars and trucks, also huge drag on the overall CPI, just because we've seen such a big move all the way down to -2.42% deflation month over month, which is pretty wild. But yeah, overall price pressures are heading in the right direction. So I think the services sector in particular is a little bit stickier, and there's kind of some inflation left there. But overall, we're seeing a positive trend towards disinflation or deflation. Although, why are we seeing that? Could be recession, not necessarily a good thing. So definitely keep that in mind. All right, let's transition to, let's go to the producer price index real quick. So like I mentioned, producer price index also slowed, and a lot of people view this as a leading indicator for inflation or CPI inflation, just because this is the input for producers, for like big companies and whatever, like commodities and all that stuff. That is like the precursor to all these goods and services and their prices. So seeing a decline, or at least a positive move in, as in like a downward move in the producer price index, is a good sign, especially for future inflation. And actually, I'll just read this. So the producer price index for final demand in the U.S. rose 0.2% month over month in October, the same as a downwardly revised 0.2% increase in September, and below market forecast of 0.4%. So usually below forecast is the key thing to focus on, because that's what moves the markets, not necessarily the actual headline number. But compared to the same month in 2021, producer prices were still up 8%, but it was the smallest increase since July last year. So inflation isn't gone. 8% year over year is not ideal by any stretch of the imagination, but we are seeing a move in the positive direction overall, just for all these different, we got tons of different baskets. I'm not even talking about PCE, which is arguably the most important, because that's the one the Fed uses to, its 2% target is for core PCE. So CPI is kind of, a whole nother thing. They're obviously very correlated, but anyway, I digress. So let's transition to our next story. Going to be a lot of inflation stuff today. So this is the Fed basically talking back after the market rallied ridiculous. After the inflation numbers came out, NASDAQ ended up being, shot up like 7%. It was just absolutely nuts. Everything was rallying. And so naturally the Fed comes in and says like, hold up. We're not, they don't want to see that. Like I'm sure appreciate the inflation going down, but they're not trying to see markets rally and go crazy. It's kind of the opposite of what they want. They want to contain monetary conditions. But anyway, I'll just get into this. So the Federal Reserve officials welcomed Thursday's news showing that inflation rose less than expected last month, and they noted that interest rate increases could slow ahead. And that would be why the market rallied, because they think the terminal rate would be lower, or just rates in general won't be as much as previously expected.
Totally.
But they also cautioned against getting too excited by the data, saying that prices are still far too high. 1 month of data does not a victory. Whoever wrote this, I think, fucked up. So 1 month of data is not a victory or make a victory. God, who wrote that? And I think it's really important to be thoughtful that this is just one piece of positive information, but we're looking at a whole set of information. And they also want to focus on multiple prints, not just one. I mean, just imagine if, this print is 7.7% for headline, maybe the next one is 8%. Not that it's going to be that high or even higher at all, but still, the Fed wants to see not just like an outlier. They want to see consistent prints headed in the right direction. So while Daly, this Fed official, said the report was indeed good news, she noted that inflation running at 7.7% annual rate is still far too high and well off the central bank's 2% goal. Got to keep that in mind because they are trying to get back to 2%, not 7%. So they still got a long way to go. And 7.7% is better than 8%, but it is not close enough to 2% in any way for me to be comfortable. And that's Daly, the Fed official, saying that. And finally, with inflation still elevated and likely to persist, monetary policy clearly has more work to do. So they are basically coming out and trying to put their foot down, saying this is not the end of tighter monetary policy. Our goals have not been achieved, even though this is positive information. And, if we can continue to see this trend, it may influence monetary policy insofar as there are fewer rate hikes and the terminal rate maybe gets a little bit lower, which is, I guess, good news in general for markets and price action. It's bullish. They do not want things to get out of control, especially because if the market starts turning, and it can kind of create this wealth effect that contributes to inflation. I mean, if the market rallies a bunch, people make more money. They're maybe more willing to spend money in the economy and contribute to price pressures and all this stuff. And the wealth effect is definitely a factor that the Fed considers. So, maybe they are close to pivoting, but they still want to see multiple prints, a lot of evidence, a lot of data signaling that things are really turning around. They're not here to risk the double top in inflation like in the 70s. And Powell has said that specifically because that's what happened to Volcker, who he's kind of, his idol, who he's modeling his policy in some sense after. Volcker he let his foot off the gas in terms of raising interest rates. Inflation came back. He had to raise rates even more, and it was kind of this complicated mess. So Powell's trying to avoid that, meaning, higher rates for longer and not letting his foot off the gas just because inflation went down a little bit, because he's very aware of the potential double top in inflation with it coming back with a vengeance after kind of receding a little bit. So keep that in mind. All right, let's keep the ball rolling. Transition to our next story. So Japan inflation is likely to hit a 4-decade high. I think the numbers come out tomorrow on Thursday. I'll double check. I think it's in my week ahead. But either way, they're coming out soon. So Japan's core consumer inflation rate is expected to hit a 40-year high in October as a weak yen pushed up raw material costs for companies, leaving some with little option but to pass those on to households by hiking prices. I actually remember reading some other story about a popular Japanese candy that's been around forever. It's kind of like a cultural thing, not just like a random candy. Is like the company that creates it is going out of business because of price pressures and inflation. Hard for me to like give an equivalent, but maybe it's like if Snickers went out of business or something. I don't know, but still, I thought they made a whole story about it, so I thought it was funny. But bottom line, the inflation pressures are finally starting to really hurt Japan, because it's always been this concern with them maintaining their easy monetary policy. Basically yield curve control and letting the currency be the release valve. And now that's starting to really reflect itself. The consequences of those actions are starting to reflect themselves in their inflation numbers, which they've struggled to even get 2% for a while, and now I think they've had like half a year straight of above their 2% target. But anyway, let's move on. So a surge in imports likely led to a $11 billion trade deficit last month for Japan, extending the run of shortfalls to 15 months and keeping downward pressure on the yen. The nationwide core consumer price index, which excludes food but it includes energy, was expected to rise to 3.5% in October. The jump would mark the fastest gain since April 1982 and would come in above the prior month's 3.0% advance. It also suggested that the CPI would stay above the central bank's 2% inflation target for a 7th straight month. Now, they've failed to meet that or reach that target for a while, and a lot of these central banks, they practice like an average 2%. So if you're below it for some time, then you're okay to be above it for some time. And Japan has been below it for a very long time. They've struggled to sometimes even maintain 1% inflation. So just because they are above it for 7 months doesn't mean this is a crisis necessarily. I believe, like Kuroda, and who's like the pal of Japan, he's talked about being fine with inflation for some time just because they have been below their target. Now, obviously, there's political pressures if inflation gets too crazy and your favorite candy goes out of business.
And we say bye-bye.
But still, it's a big deal. 40-year high is a big deal in pretty much anything for the most part. All right, let's wrap this up. Despite the broadening price pressures, which are growing concerns for households, the Bank of Japan has rejected joining a global trend of raising interest rates, vowing to stick to its ultra-easy policy and dovish guidance.
You're a fucking idiot.
So far, it hasn't been catastrophic. I mean, the yen has depreciated ridiculously, and that's obviously contributing to these inflationary pressures. But I am somewhat surprised in that the Bank of Japan has been able to maintain their yield curve control and basically zero interest rates, while everybody is, like the Fed specifically, is raising rates so aggressively. But who knows? Maybe they will catch the pivot just in time and be able to come out unscathed. But you can see it's starting to really affect them. The inflation pressure is really starting to arise, and who knows if it gets worse. I mean, it's obviously headed up. We got 3% the previous month and potentially 3.5% this next month. And who knows after that, maybe even 4%. But stay tuned. So inflation finally starting to become a meaningful problem for Japan. All right, let's transition. Again, another inflation story. It's a big deal, guys. All right, so this is for the UK, and these numbers just came out today on Wednesday. The annual inflation rate in the UK jumped to 11.1%. God damn! Kind of wild. And that is from 10.1% in September. So when you thought the 10 handle was crazy, I mean, they're literally up a whole percent. That's pretty wild. It's an aggressive move, not even just like a few basis points. And that was above market forecast of 10.7%. So that is a huge miss. I mean, think about how much the U.S. market rallied off of the 30 basis point miss to the downside, the positive one, 7.7 versus 8. And this is a 40 basis point miss of 10.7 versus 11.1. So it's not good. So it is the highest inflation rate since October 1981, with main upward pressure coming from housing and household services, 26.6% versus 20.2%. And most notably from gas, 128.9%. And these numbers are year over year, I believe. And then electricity up 65.7% year over year. However, this is actually a key part. So, however, the price rises in energy specifically were constrained by the energy price guarantee of the government. So after the energy crisis and it started really affecting the UK, the government implemented this price guarantee, basically a price cap in some sense, where they would just not let prices go over a certain level and they would kind of subsidize it. So without that energy price guarantee, the average unit cost of gas, this is the, they capped it at 10.3, forget what the metric is, whatever, the kilowatt per hour, and electricity at 34 per kilowatt hour. Without the guarantee, the average unit prices for gas and electricity were expected to rise, I think like about 50% more. And I guess to simplify this, inflation absent this or without this price guarantee would have been 13.8%. So 11.1% versus 13.8, just because they had this price guarantee. So, you have to keep that in mind. I mean, the government is shouldering those costs. That's obviously maybe, I guess, consumers aren't, which is good, maybe in the short term, but that inflation still exists. It's just being artificially suppressed by these subsidies. So I personally would think that the 13.8% number is what you should focus on, because that is what actual prices are saying, absent this intervention and this cap. So 11.1 versus 13.8 because of that price guarantee by the government. And just real quick, you can see this graph of the inflation for the UK. I mean, just steep incline, especially with this most recent print, because I guess we had the 10.1 in July, and then we retracted or retraced to 9.9, had another 10.1, and now this huge jump to 11.1. I mean, that is a sizable increase. Definitely not signaling the end of this inflation. Not saying that isn't the top or anything, but not good for the UK right now. At least the US is seeing the positive change in inflation, headed in the right direction. But other places like Japan, UK, a lot of others I'm not going to get into, definitely still struggling to tackle that dragon. All right, let's transition to our next story. Whoops. So for those who don't know, there is these EU sanctions on Russian oil are about to go into effect in a few weeks. And so we're already starting to see Russia kind of, contend with that, work around it. So diversion of Russia's crude oil exports to Asia is gathering pace, with record volumes heading on tankers to the region's ports. The need to switch is becoming more acute as a ban looms on seaborne imports into Europe, which was previously Moscow's core export market. So 2/3 of crude loaded onto tankers at Russian ports is now heading to Asia. That compares with less than 2/5 in the weeks before the war started. And China and India form the backbone of the trade. That when they're talking about Asia, that's primarily who they're talking about. But there are minor volumes heading to places such as Sri Lanka and the United Arab Emirates as well. EU sanctions, which will halt almost all seaborne crude deliveries from Russia to the bloc's members, so all of Europe more or less, will come into force in just 3 weeks' time. The measures will also bar European tankers from hauling Russian crude and prohibit the provision of insurance, brokerage, finance, vessel classification, not sure why that matters or the specifics of that, and other services. But there will be exemptions for vessels carrying cargoes that were purchased at a price below a yet to be agreed upon cap. So they're trying to implement this cap. Sanctions are partly how they're doing it. But bottom line, this is driving Russia to find other buyers. If the European Union, all those countries are not going to buy the oil because of these sanctions, or at least not buy it at this, the natural market price, Russia being they are going to find other buyers that are willing to give them the natural market price, or just kind of play ball. So they're looking to China, to India, to really any country, honestly, that will take the oil off their hands. And so you're starting to see this very meaningful change of their exports, just millions of barrels per day leaving for places like China and India, which, prior to this was not the case at all. Obviously, the majority of it went to the EU. So the EU, and also, I guess because technically the UK isn't part of EU, so I just want to specify, the UK has also signed on to this, following the EU's lead in banning its companies from providing such services to ships. This move, like the EU sanctions, will come into effect all on December 5th. So that will be the key day where, we're already seeing this kind of unfold, with Russia changing its flows, like where all this oil is being shipped and who the buyers are. But that is the official deadline date where you're basically going to see this halt, more or less. Obviously, we'll have to see how effective it is, but this halt of oil imports to the European Union. So yeah, but that was an important story. Definitely keep your eye open for any developments leading into December 5th or shortly after, right?
Yeah.
All right, let's transition to our final story. All right, so I'm sure everybody and their mother has heard about this crypto nonsense with Sam Bankman-Fried and the FTX Alameda just Contagion. Literally everyone. My podcast stream right now is I can't not read the words or the phrase FTX, Sam Bankman-Fried. It's just ridiculous. But I'd be remiss if I didn't cover it a little bit. So crypto lender BLOCKFI says it has significant exposure to FTX, and I think within the last day or two, they have, they're going to go bankrupt, basically. They're, read between the lines. They paused customer withdrawals, and they've already, there's just a lot of rumors right now that they are going to be the next one to bite the dust. Although I suppose Genesis already kind of did. I don't know, hard to say. This contagion is rippling through the whole crypto market. Genesis, I believe, paused withdrawals. Nothing specifically about bankruptcy yet. And then you have people talking about crypto.com potentially being the next one to fall. And look, it really is potentially everywhere. There's no telling exactly how far this contagion spreads. So, just full stop. Get if you have crypto right now, any crypto at all, self-custody it. Like, that's kind of the best part about crypto, is there are no counterparty risks if you self-custody. You don't have to rely on these places, these exchanges, or other third parties holding your coins, tokens, whatever it is. So self-custody, full stop. It's pretty easy. If you can't do that, I mean, maybe pick like the most regulated exchanges. I believe Coinbase is pretty safe. I remember hearing Brian Armstrong talk on the All In Pod, and they're heavily regulated. They get their financials audited on a regular basis, and they maintain a 1-to-1 reserve. And Brian Armstrong in general is a really trustworthy guy. I don't respect Coinbase's fees. They're like, whatever, 0.5% or something, but worth it apparently, because maybe you're paying more for the fees, but you're not losing your money or risking some sort of insolvency like this. But anyway, that's enough of a tangent. Let's get into this particular story. So, cryptocurrency lender BLOCKFI said on Monday it has significant exposure to Sam Bankman-Fried's crypto exchange FTX and associated entities that last week filed for bankruptcy. This is a quote: "We do have significant exposure to FTX and associated corporate entities that encompasses obligations owed to us by Alameda." So, Alameda, which is like the hedge fund, the sister company of FTX, they lent, I believe, was it? No, so FTX actually extended a line of credit to BLOCKFI, but then I believe BLOCKFI extended a loan for something, who knows what it is, to Alameda. And so when Alameda went under, that loan is obviously just as a write-off. They have to write that down as, zero, potentially. I don't think Alameda's going to be paying it back. So that is part of their exposure to this whole entire situation. And they have a line of credit, like I said, from FTX. Back when 3AC blew up and the Luna UST stablecoin collapsed, that led to BLOCKFI, I think, having some issues, and so FTX came to save them with a line of credit. And actually, the funny thing is, I believe they did that because BLOCKFI had a significant amount of FTT tokens, the FTX exchange token, and had they been forced to sell those, I guess, hindsight now, you can kind of see this, that FTX would have been, it would have forced FTX to collapse sooner, just because it would have forced BLOCKFI to sell FTT, and selling that much FTT into an illiquid market, which is basically what FTT was, would have substantially driven down the price, presumably, of FTT, and caused a lot of problems for Sam Bankman-Fried and FTX in general, just because a lot of their assets were denominated in FTT. That was a huge part of their overall balance sheet. So if FTT went down, then they would, their mark-to-market at the time was enough to kind of, I guess, meet their liabilities. But as soon as that liquidity was tested for FTT, the price would be driven down, and the billions of dollars on FTX's balance sheet would have crumbled, and so this would have unfolded a lot faster. So it seems that is why FTX extended the line of credit. But I guess the moral of the story is that BLOCKFI has a line of credit from FTX that they never fully drew on, so that's another part of their exposure to this mess. So they had a loan extended to Alameda, a line of credit from FTX that they did not fully draw on, and then I guess they're saying they had a certain amount, who knows how many, of their assets held at FTX. So those are all gone, I'm assuming. But yeah, a lot of exposure, significant exposure, and they are almost certainly going to file for bankruptcy.
And we say bye-bye.
So it added, BLOCKFI, that is, it added that withdrawals from its platform continue to be paused, and clients have been asked to not submit any deposits to BLOCKFI wallet or interest accounts. Well, that's nice of them. The crypto industry has been bracing for a fallout of the FTX collapse, with several firms counting their exposure in millions to the beleaguered firm. And this is really probably just getting started, because if you think about how long it took FTX to implode after the Luna collapse, because that is, what it seems like really set this whole thing off, because Luna led to Three Arrows Capital collapsing, and I believe Three Arrows Capital, Alameda had exposure to Three Arrows Capital, and possibly, I guess, Luna specifically, but they, had a huge hole. They basically should have went under then, and instead, Sam took FTX customer deposits to fill that hole, fill that gap in the Alameda balance sheet, And then you had BlockFi going under, and he had to extend a line of credit. That way the FTT, illiquidity and shit show that ended up leading to this wasn't exposed. And so this more or less kind of stemmed from that initial collapse. And so if it took that long for this to happen, who knows how long it's going to take for some of these other companies to collapse as a result of this, which is way bigger. I mean, more people undoubtedly have exposure to FTX than to something like 3 Hours Capital or even Luna. So this is huge. We're going to see this probably, stories evolving, coming out related to this for months, I'm sure, maybe even longer. But like I mentioned in the beginning of when I transitioned to this crypto story, BlockFi is just one of the many. I mean, we got Genesis that's pausing withdrawals. You have Crypto.com, who's doing like some weird like shifting of funds, possibly to appease its customers in some snapshot audit. Like they transfer funds, take a picture of their balance sheet, see we have the funds, and they transfer back to like another custodian or bank they just had this agreement with. Who knows? So bottom line, I would get your stuff off exchanges, away from third parties, self-custody. If you don't trust crypto or believe in crypto at this point, obviously sell it. But I think I would just focus more on the OGs. Like, if anything, this hardens the case for Bitcoin. I think people are starting to understand like why Bitcoin has been around so much longer, why it is the OG, why it's important. Because, I mean, number one, Bitcoiners always promote self-custody and eliminating counterparty risk. They don't trust exchanges. They don't trust all this nonsense. And obviously, Bitcoin has fallen a lot too. I mean, it's not immune to this. There's kind of this whole crypto contagion. But in general, it's a lot easier to trust Bitcoin versus what ultimately ends up being like these Ponzi schemes. Solana, people had a lot of faith in that. And now with Sam Bankman-Fried collapsing and FTX collapsing, and he was basically betting on Solana, and so he had a lot of exposure there. They had a lot of just nonsense, and so Solana is potentially just bye-bye, gone. And obviously FTT and other exchange tokens are worthless. So you really need to focus on what you can trust. And personally, I think Bitcoin is probably the only one at this point. Although there is definitely an argument for Ethereum, but much of the same stuff that kind of affects these other companies, like this kind of like circular, hole in their funds, is based off of like all this collateral that technically has no like intrinsic value, like Ethereum. Like, who knows? I mean, obviously there's utility, I suppose, but I don't know. I'll wrap this up just by saying self-custody, focus on Bitcoin, maybe Ethereum, but don't get discouraged, because this stuff is just naturally greed finding its way into markets and now being exposed just from people getting, like I said, over greedy and leveraging to the nth degree. But I just hope that this doesn't discourage people too much from crypto and instead turns their focus to something like Bitcoin.
My man.
All right, well, that was more than enough, I'm sure. So let's just go ahead and get to our week ahead. Give me one sec here. All right, so later today, I believe I mentioned this earlier. Maybe not actually. So this Japan balance of trade numbers come out, if you're interested in that. And then tomorrow we get U.S. housing starts and permits, EU inflation numbers. 9.9% is the, I believe, expectation versus 10.7 previous. And we also get U.S. initial jobless claims and Japan's inflation numbers. So, I believe, I got that mixed up. So the EU inflation numbers, the previous month was 9.9, and the expectation is 10.7. And then Japan's inflation numbers, which are also tomorrow, the previous month was 3%, and the expectation is that 40-year high of 3.5%.
God damn!
And then on Friday, we get UK retail sales numbers. We'll see how terrifying those are. And President Lagarde, so the president of the ECB, is going to have a speech. Maybe she says something meaningful, maybe she doesn't. And then finally, we have U.S. existing home sales come out. So that is the week ahead, the most important things to look out for. But that is all I have for you today. Aww. So, as always, stay happy, humble, and in these troubling times, especially solvent. I'll catch you all next week.